The advising industry is incentivized to have you save money pre-taxed. Politicians say tax the rich. Do they tax the rich currently? Does Warren Buffett have an extra tax? They tax your ability to get rich. They tax your income. So where your money sits is more important than the rate of return you're trying to chase because of these unknown taxes. That the strategies you use growing your assets, going up the mountain, accumulating your assets, exposed to the volatility, are different than the strategies you're going to use to decumulate or maximize your cash flow. Do you expect to do the same thing that you've done to get you to where you are? Do you expect to do the same thing on this side so that you can maximize it? So true diversification includes volatile assets, the stuff that goes up and down, and guaranteed assets, a portion of your money that will never go down in value. True diversification in retirement has taxable assets and tax-free assets. If tax rates drop, taxable assets look really good. If tax rates go up, tax-free looks pretty good.
Now I get it. Retirement can be confusing. 90% of the people out there, I believe, make retirement way too complicated. And so what I want to teach you over the next hour from one of my recordings of a live tax-free Tuesday, which you can join. But what I want to teach you is two financial principles that will help you spend likely up to twice as much money in retirement years without taking more risk. And all you have to do is two changes. That's it. Two things to understand that aren't subjective. It's not an opinion. It's just learning how the rules work when it comes to income planning. Okay? So the next hour that you're going to watch is absolutely free. I don't charge for this. And I want you to understand this is not financial advice. Okay? I'm trying to teach financial principles that you can apply to your own personal situation. So before you make any financial or tax decisions, make sure you talk to a licensed professional before you do so. They can guide you through your personal situation, exactly where you are and where you want to end up. If you want that to be me or someone from my team, click the link below that says schedule your one-on-one strategy call. Absolutely free. The goal of that call is to understand where you are and where you want to end up. So enjoy the next hour, get a notebook ready, take some notes, and hopefully we'll talk to you soon.
You're in the right spot if you want to learn how to pay taxes once and avoid future income tax. This is not tax evasion. That takes you to jail, and it's absolutely illegal to teach tax evasion. I want to teach you how to use the tax code to your advantage so that you pay taxes once and can avoid all the ancillary taxes in retirement. Okay, real quick, my name is Matt Love. I started a company called Cash Flow Architects. You'll see it up there. It's not called Income Architects because income is taxable. Cash flow is not. It's not called Asset Architects because what are you concerned with? The growth of your assets or the spendability of your assets? The spendability. So I started Cash Flow Architects about 4 or 5 years ago. I've been in this industry for about 15 years, helping people understand how to avoid unnecessary loss, how to avoid unnecessary taxation, how to have control over your money so that you can have more without taking more risk. And when you choose to take risk, you're in control of that. Does that sound good? Does that sound like what everybody wants to talk about today? Sheila, absolutely. Everybody on the call will get a copy of this webinar. You'll get a replay so you can watch it with your spouse. Share it with all your friends because we do such a good job. Absolutely, Nan. We want to spend our money. So before I get going, I want to ask a couple of questions so that you guys have perspective. Okay? Who here, right now, the government is pretty broke. There's no secret there. Trillions of dollars in debt. Well, there's only two ways the government makes money. They can spend less, which hasn't happened in the last 30 years, or they tax the citizens to increase the revenue. So over your lifetime, do you think tax rates are going to go up or down? Let me know in the chat box. Nan says up. Everybody else agree? David says up. It's likely that they're going to go up. Now, when they go up, who do they go up for? We've all heard this saying, makes me throw up in my mouth. Politicians say tax the rich. Do they tax the rich currently? Does Warren Buffett have an extra tax? No. Middle class. David's right. Man, exactly. They tax your ability to get rich. They tax your income. So where your money sits is more important than the rate of return you're trying to chase because of these unknown taxes. Taxing your ability or the enjoyment of all of your savings is where they make money. So understanding the distribution side can increase your income drastically. Linda's right. The regular folks are the ones that pay for it. Let me ask this for perspective. If I said you make more money than 90% of America, married, filing jointly, what income level do you think you need to be at to be in the top 10%? How much income a year do you think you need to make to be in the top 10%? Sheila, thank you. Everybody read Sheila's comment. I didn't even pay her to say that. Looking forward to it, Sheila. Thank you. But how much income do you have to make to be in the top 10%? David, it's a little more than that. It's about 150,000. So if you're making over 150,000, you are making more than 90% of Americans. You are the one who's rich. If you have over a half a million in assets, this meeting is going to be very important for you. Quick story. I have a master's in architecture. Um, I thought I wanted to be an architect, and I love architecture. However, the profession kind of failed me. But when I was 24 years old, 25 years old, a friend of mine, his mom passed away, and he inherited an IRA, 401k in the chat box. Who has a pre-taxed retirement account right now? Just say me. Don't say, you don't need to say the number, just say me. Well, when my friend inherited this IRA, he had to pay tax. Now, when did he pay tax? Did he pay tax just on the inheritance? He had income. He had to pay tax on the inheritance on top of his income. Who here hates debt? Anybody here hate debt? We are taught to hate debt. It's a four-letter word. Yet we have people on this call who have been confused and tricked by the financial industry to fund accounts like a 401k or an IRA pre-taxed, funding an account hoping that it grows, and we can't even calculate how much debt we owe. And most people on this call think that the debt or the tax is going to be higher in the future. Now, what happens as your account value grows? What happens to your tax liability? It also grows exponentially more than your account value, because the more you take out, the more the taxes are. So we've been tricked by Wall Street and these financial advisors to say that you need a retirement account to retire. You don't. What do you need? You need money. You need money to retire. Cash flow, not a retirement account. The advising industry did a really good job of tricking people thinking that you needed to have this retirement account to retire. You don't. So I'm going to go over three things. At the end of this, I'll show you how to double your income or what you're on pace for. Okay? Gosh, I'm nice. All right, secret number one. There's no tax savings in a qualified retirement plan. It's a postponement. Now, if you're realizing this, give me a thumbs up. If you're questioning that, give me a question mark, because I'm going to go into this for a second. There's no tax savings. As you put money into your IRA 401k, did you ever get the money? Did you ever see it? Did you ever touch it? Did you ever smell it? No. So you didn't pay any tax on it because you never got the money. Who got the money? Wall Street and your advisor. No problem, Sheila. Talk soon. Wall Street got the money, and your advisor's getting paid to manage it. Is your advisor charging you a fee on just the after-tax portion? Hold on, Linda. It's a postponement. You didn't pay tax yet. You have to. In order to buy groceries, you're going to have to pay the tax. And when you're married filing jointly, you're in a different tax bracket. When one of the spouses is deceased, you're all of a sudden married or you're single. So the condolence from the IRS is changing your tax bracket from married filing jointly to a single tax bracket, which is higher. And when you're 73, they have what's called RMD. You're required to take money out. No longer can you postpone the tax. You have to. And then when you are deceased, the money goes to your beneficiaries. They have 10 years to get that account to what? Zero. On top of their own income. So while you think you're getting tax deductions, what you've really gotten was a tax deferral. You've just postponed the tax bill to a time frame you think tax rates will be higher on an account value that's even bigger than when you started. And when you're working, you have kids at home. I call them tax credits. Now, I don't say it to their face. I call them sweethearts. I have 3 little girls, but they're tax credits. I have a mortgage. I have deductions because I'm working. In retirement, those things go away. Now, is an IRA a bad thing? No, but I surely think that most people don't understand how to spend money. Watch this. Let's say you put money into an IRA. You have $1 million. How much is yours? You have $1 million in the IRA. How much is yours? Chat box. Linda, for example, please, how much is yours if you have $1 million? Now you're getting somewhere, Linda. If you took out all $1 million, you'd have even less. The truth is, we have no idea. But guys, if you take out $1 million, you're in a 37% tax bracket. You're not in a 25% tax bracket. It gets worse the bigger this account gets. But let's just say it's 750. I would say closer to 600, but let's say it's 750. Depends on the state you live in too. Is your advisor charging you a fee on 750 or the full million? Is your advisor charging you a fee on your portion or the full million? Amen, Linda. You're getting it. You guys are smart. That's why you're here. There's going to be parts of this call where you're a little uncomfortable, and that's good because it means you're learning things. So you're in the right spot. So thank you, Linda, for participating. The advising industry is incentivized to have you save money pre-tax. The advising industry gets a pay raise on pre-tax money. They don't share in your risk. They get paid on money you have to give to the IRS, or your spouse or your kids have to give money to the IRS. The bigger the account, the worse this gets. Now, when you put money into this, Linda, you got to postpone tax on what? Your federal tax, your state tax, and maybe a local tax. And for everybody just joining us, open the chat box. That's the best place to communicate. Got dozens of people on this call. We're almost at 100 people, which is awesome. Open the chat box, communicate with me there, react to this, ask questions. When you put money into this, you've postponed these 3 taxes. Now you're age 65 and you want to retire. You want to live to age 95. You start taking money out. Well, you have this thing called Social Security that you've been counting on. By the way, that's also going broke. But you have Social Security that you're going to be expecting. Did you know that 85% of your Social Security can be taxed as ordinary income. 85% of the benefit you're expecting can be taxed as ordinary. Did you get to postpone that in the beginning? Nope. That's a new tax that lasts for life if you don't pay attention. Now, if you're making 40,000 a year in Social Security and you're in a 25% tax bracket, that's 10 grand a year in Social Security benefits you have to give back. And let's say you live 25 years, that's a $250,000 mistake. You're voluntarily giving more of your benefit back to the government because nobody told you how to exit this. You're exposed to RMDs, which require you to take money out. And depending on how much you make, you could be exposed to IRMA or Medicare tax. Did you postpone that while you were working? No. You're choosing to add on more taxes, trusting the government. When does the government help wealthy people? Do you know how many people on this call have millions in account values that don't feel wealthy? Because you're a saver, you're not spending it. So these taxes are the ones that I'm also trying to avoid over my lifetime. So how do we fix it? Pay tax once. So that you can avoid all of this. By the way, your advisor is charging you a fee. And let's just say it's 1%. After all of these taxes get paid, after the advisor gets paid, then you get what's left over. That stinks. So if you retire, and we're going to spend a minute on this, and you want to live for 30 years in retirement, how much of the million can you take out without worrying about running out of money? There's been a lot of studies. The number one concern retirees have is running out of money before they run out of life. Dying broke. It's the number one concern. So in order not to die broke, you know what the financial industry says? Don't pull out more than 3.5%. In other words, $1 million in account value will produce around $35,000 a year. And then you have to pay all this and you get whatever's left over. 35 grand a year, guys. $1 million took a long time to save. The IRS didn't share in your fees. They didn't share in your risk. The advisor got paid. They're not sharing in your risk. And you're going to live on 35. If the advisor's getting 1%, they're making 10,000 for you to live on 30. They only need 3 clients. 4 clients. Just like you to duplicate your income. You ever wonder why advisors wear $3,000 suits? A lot of money in this game, especially on a pre-taxed account. Give me some thoughts, some feedback on this, guys. This is the biggest problem. 35,000 is crap for income, and this is way too much in tax. Who wants to fix this? Type in me. Not fair. Thank you, Elise. It's not fair. And I've been part of a number of agencies, financial advising agencies. And as you can tell, I kind of go against the grain. I pissed off a lot of financial advisors. I get advisors, there might be one on this call right now just listening. I'm not saying don't be involved in the market. You should be. You could be if you want. I'm not saying don't do an IRA. You probably already have it. You have what's called an enviable problem. But my gosh, if you don't fix your existing position, the cash flow you're on pace for stinks. Thank you, Tony. All right. Secret number 2. Where your money sits is more important than the rate of return you're trying to chase. This is not a subjective opinion. This is an objective principle. I'm going to prove it by the end of this call. We're already 20 minutes in. I'm going to try to go fast. Where your money sits is more important than the rate of return because of taxation, market volatility, all of these things. So who here has heard of this? Whenever you sit with a financial advisor, one of the first things they do is a risk assessment test. How much risk should you be exposed to? And then you come up with portfolios like 60-40 or 70-30 or 80-20. And what does that mean? You're diversified with stocks and bonds. Now, that's okay before retirement. Why? Because the market does this. And you ever heard this saying when when the market's down right here, don't worry, Tony, don't worry, Elise, you're in it for the long run. Well, the long run runs out. Matt, when does the long run out? I'll tell you. Master's degree in architecture, and that's a mountain. Amen, man. All right. If you were to go mountain climbing, what's your ultimate goal? Is it just to get to the top of the mountain? Or is your goal to get to the top of the mountain and then back home safely? It's to get back home. So the top of the mountain is what I call retirement. Congratulations, you made it. You won. Are you trying to now turn your million into 2 million over your lifetime? Or are you trying to maintain? So here's the idea that growing your assets before retirement on the left-hand side of this mountain, it's called the accumulation phase. That's where this volatility is okay. On the right side of the mountain, I call it the decumulation. This is when you spend. Is the goal to get it to zero? No, the goal is to maintain and maximize the cash flow so you don't go broke. So everybody get the chat box open. I want to ask your opinion. Is this a new concept or a difficult concept to comprehend? That the strategies you use growing your assets, going up the mountain, accumulating your assets, exposed to the volatility, are different than the strategies you're going to use to decumulate or maximize your cash flow. Do you expect to do the same thing that you've done to get you to where you are? Do you expect to do the same thing on this side so that you can maximize it? Let me know in the chat box. Is this a new? Thank you, David. So what you do with your money and where it sits is more important than the rate of return. There's different tools that will help you retire. And I'm going to use words that you've probably hated during this phase because those tools weren't appropriate in this phase. But they surely are appropriate in that phase. If you want more money with less risk. Do you want to be 75 years old and have another 2008 happen? No. Can you imagine being 80 and having 2022, the S&P 500 dropped almost 20%? Do you want that? Do you want to have all of your money exposed to that market volatility? No. Some, but all? Not if you want more money with less risk. So true diversification includes volatile assets, the stuff that goes up and down, and guaranteed assets. A portion of your money that will never go down in value. True diversification in retirement has taxable assets and tax-free assets. If tax rates drop, taxable assets look really good. If tax rates go up, tax-free looks pretty good. So now you're starting to understand, and let me know. I get it. Thumbs up or something in the chat box if it's starting to click. What you do during the accumulation phase is going to be different than the maximized stage. And I'm going to prove it to you right now using numbers. I'm going to get a little nerdy because I think it's important. It's important to understand what I mean by this. Stocks and bonds are great. I'm not saying don't have them, but you better have something guaranteed and you better have something tax-free if you want to maximize your cash flow. Because retirement's different than accumulating. There's different risks involved. All right. This is looking at the S&P 500 from 1970 to 1999, some of the best years. So think about this. This is the best 30 years the S&P has ever seen. The best years the S&P has ever seen. Let me preface this whole thing. You can't guarantee a rate of return that will get you out of this problem, that 3.5%. That's the problem. So watch this. Randy, I'm going to do it right now. There's a difference between average rate of return and actual rate of return. And in your working years, you don't need to figure that out. In retirement, you better figure this out. And if your advisor's not teaching you this stuff, they're not specialized in retirement. They're specialized in the accumulation. You could be sitting there, why isn't my advisor told me this? We already went over that. I know, I told you why, because they incentivize to have you stay in the market. So over this 30-year time frame, the average return for the S&P is almost, I'm going to call it 15%. 15%. Phenomenal. Phenomenal. It did great. And so you get these financial entertainers on in the radio. Some are located here in Nashville, if you know what I'm saying. They'll say, if you have $1 million in your account and you want to live 30 years, surely just pull out 10%. Gosh, the market's averaged 15. So you could take out $100,000 a year, 10%. And on average, they're right. But does the market work with averages? No. If the market worked like math, there would be a lot more millionaires walking around right now. But it doesn't. So this 30-year time frame, the market's averaged 15%. Randy, you tell me. So $1 million account value, and I'm going to pull out 10% or $100,000 a year. What's happening to the account value? It's growing. Why? Because the market's averaged 15 each year. It's going up. Does the market actually go up every year? Nope. But according to the math, it works. You can live on 10% distribution. You'll be fine. That ain't reality. Let's look at the real rate of return, the actual rate of return. The actual rate of return in the first year was only 4%. Then we had 2 years of some good growth. But then what happened? Some negatives. And then year 6, wow, that's a phenomenal year to be in the market. So let's apply the distribution strategy of a 10% distribution when we plug in the actual returns. Okay. Average 15, taking out 100 grand. Start with $1 million for 30 years. So first year, taking out 100, the market only did 4. So what happened to the account value? Did it go up or down? It went down immediately because you took out more than it grew. The next 2 years, we saw some growth. The market's doing better. Years 4 and 5, what happened? Market drops. What happened to the account value? In year 5, you have half as much money left over. But Matt, the market is averaging 15. The market, that's the best 30 years that the market's ever done. And what happens by the time you're in your 14th year of retirement? In the chat box, what happens? What happens in year 14 in this graph? This isn't opinion. This isn't me saying you should have got a different stock or a Bitcoin or whatever. Linda's right. You're broke, dude. You're broke because your advisor possibly wasn't acting in the fiduciary capacity. You have no money. You have no money. Broke in 14 years. In the best time frame that the market's seen for 30 years. Is that a problem you want to fix? So here's what the industry says. The industry says if you want to live 30 years, you should take out about 3.5%. And if you do that, you have a 90% chance of not running out of money. And if you take out more, if you take out 4, your percentage goes down. If you take out 5%, you only have a 60% chance. 60% chance of not running out of money. If you got on a plane and the pilot said, welcome aboard, welcome, so glad you're here, we have a 60% chance of making it to our destination. Go ahead and enjoy the crackers. You'd get off the plane. So what have you done to get to this point? You've done a good job of saving money. But the person who you're working with hasn't, if they haven't shown you this, I'll have my calendar link here in a minute and I'll share. You guys can jump on my calendar. I don't charge anything. This is principle based. This is principle based. This is not based on an opinion. If you start taking out 8%, you have like less than a 10% chance of making it. So how do we increase income without taking more risk? Simple. Two buckets of money. One that goes up and down, and one that only goes up. Why? Because when the market's down, I'm going to use this bucket to generate cash flow. When the market drops, not if, when the market's down, the account that doesn't lose value is going to generate income or cash flow. Okay? Now, how do we do that? Who cares? As long as you have an asset that's guaranteed not to lose and ideally tax-free. One of the ways to do this, Randy, is annuity. There's multiple ways. You can use annuities. You can use life insurance. You can use Roth with guarantees inside of an annuity. So how we do this, that's where we get subjective. What product is going to determine on you, the person? But if you don't have the guarantees, you're subject to volatility for the rest of your life. If you don't have tax-free, if you don't have life insurance or a Roth, you're subject to what? Lifetime taxation. And I already went over how many that look at all these taxes. You're subject to all of this for life. Or you move the money, pay tax once, and you set up guarantees so that you don't lose money. Great question. Elise asked a question I want to talk about. I get conflicting info on annuities. Some people think it's good, some think, say it's bad. Who do you believe? At some point, at some at some point, you have to find someone that you want to work with, and you have to go through the noise because people could say, look at food. Eggs are good for you. Well, the egg white is not good for you. You should only eat the yolk. Well, the egg's actually all good for you. Well, the egg white is the good part, but the yolk is bad, so just eat the egg whites. These are opinions. Get rid of opinions. Go to principle first. Principally, if you want this, that's the first decision. Then we figure out what type of product to use to create the benefits that I'm looking for. So there's different types of annuities. The reason people say it's bad is because people made the wrong decision. So if I said I want my annuity to grow, I want market growth with no downside. You can do that. And if someone bought an annuity for income, it might not give them what they wanted. So then they blame the annuity when it was the wrong decision in the first place. It wasn't the annuity's fault. That person put money into the wrong type of asset. Does that make sense? Long-term care. How many people have had an experience with long-term care with a loved one? Extremely expensive. You can get annuities to pay for long-term care. Hell, you can get life insurance to pay for long-term care. So that's guaranteed to pay a death benefit to your family, but if you need care, the death benefit can go to the long-term care. So don't fall in love with the products. Fall in love with what they can do for you. So this is why I didn't start off with annuity. I started off with guarantees. I need a portion of my assets that are guaranteed so that when the market goes down, not if, I don't have to be taking money out in a down market. Now, do you want to figure this out when you're 55 or when you're 75? 55. The sooner you figure this out, the more you will enjoy retirement. Okay, now I'm going to get back on track here. So this is why they say take out 3.5%. I can double that for you. Okay, so let's say you have $750,000 in the market that goes up and down, and we have $250,000 in cash. Now, do I recommend this? No, but what is cash doing? It doesn't really grow, but it certainly doesn't lose. It's guaranteed to be there. Okay? So I'm going to move 25% into cash. Now, not in the IRA, I'm just talking about in the bank. Watch this. Now I can start taking 10% distributions. Now, if I had $750,000 and I'm taking 10% out each year, as I'd said, we're going to go broke in year 14. And I don't have a crystal ball. So I'm not going to guess what the market's going to do the next 12 months. You guys have been guessing your entire accumulating phase of your life, and you've gotten away with it because you're in it for the long run. Well, the long run's running out, and it happens at retirement. So just by having money in cash, I have an alternative. I can have a second bucket of money. Okay. And I don't have a crystal ball. I'm not going to guess what the market's doing. At the end of the year, we have an income planning meeting, and we look back over the previous 12 months and we say, what did the market do? If the market didn't do my 10% of return that I'm looking for, then the next 12 months, I'm not going to sell at a loss. I'm going to use my cash for income. That's this column, the green. All right, everybody, look at this. First year, market doesn't do my 10%. The second year, how much in the chat box? Let me know. How much am I pulling out of my investment? How much did I pull out of the investment? Got 100 people on this call. You guys open the chat box. I don't want to talk to people. Zero. Karen, thank you. Zero. Where did the income come from? Cash. You got it. Year 4, market didn't do well. So year 5, I'm not pulling money out of the market. Year 5, the market sucked again. I'm using my cash. Just by having 3 years of a buffer, how much cash is left over in my investment after 20 years. After 20 years, you would have more, in this example, more than when you started because you started with 750 in the investment. After 20 years, there's more in the investment than you started with. Guys, no, Bill, you are not, it's not too late. You need the guarantees. Okay. So follow me on this. Now that we understand moving 25%, on average, we do 25 to 50% into a guaranteed bucket. Do I use cash? No. Why? Because what's the rate of return on cash? It stinks. And any growth you get on cash, you still are paying a 1099. This is why I'm not a fan of CDs. If you're doing CDs, my gosh, pay attention. The CDs trigger tax every single year, not as a capital gains, as ordinary income. So how do I get growth, safety, guarantees, and tax-free? A couple different ways to do this. Let me show you one. That's my volatility bucket. Here's my guaranteed bucket. I do a rollover. I move money from my IRA into my new IRA. How much? 25 to 50%, depending on age. Okay? I roll over. Is there any tax due on that rollover? No tax. But I solved no tax, no tax due on the rollover. But I solved my first problem, which is the guaranteed. Now, how do I pay tax once? This is really cool, guys. And we're 46 minutes in. I'm going to wrap up here in a minute. Inside this guaranteed bucket, you have your IRA. You can set up a Roth. Did you know after the age of 59 and a half, you could put money into the Roth? More than 6 grand a year? It's called a conversion. You do a conversion. This is where you pay tax once. Inside the Roth, there's no federal tax, there's no state tax, there's no local tax, there's no Social Security tax, there's no IRMA tax, there's no RMD, and there's no inheritance tax. You pay tax once to avoid all the future taxation inside of an account that only goes up. Can't lose. David, forgive me, I don't know what you mean by for now. I might have said something. Oh, yeah, changing taxation of the Roth. Agreed. Yeah, exactly. No, I agree. I agree. Yeah, we didn't have Roth didn't exist a long time ago, and you were capped. If you made too much money, you couldn't put money in. You were capped at how much you could put money in. It wasn't as attractive. The other way to do this is life insurance. You pay tax once, the money goes into life insurance. These same benefits are over here, but I get a death benefit and I get a long-term care strategy built in. So depending on age and health, that's another option for the people that are asking already. Which one do we use? I'm not going to go into all these details and examples. I want to do high level stuff here. So, Matt, how do we convert? How many CH can you roll over to a Roth? As much as you want. So here's how we calculate that. Above $96,000, I'm only in a 12% tax bracket. So if someone is making 50 grand a year of income, how much can I convert and pay taxes once? and still be in the 12% tax bracket? 46,000. This is how we do this on an individual basis. Matt, how much can I convert? I don't want to bump up into a higher tax bracket. Gosh, no, we don't want to. But you can, if you're only living on 50K, we could take out another 46,000 because you're still under the 96,000 of the tax bracket so that you're not in a higher tax bracket and you can pay tax once in the smaller bracket. Now let's say you make this person is making let's say they're making $100,000. How much can you convert in the chat box? How much can you convert and stay in the 22% tax bracket? So you're not in this 24% bracket. How much can I convert? What is this? Tony's getting it. 106. Vicky got it. 106. And still be in the 22% tax bracket. How cool is this, guys? Let's say you're crushing it. Let's say you're making, $230,000. Well, the next tax bracket doesn't start till 394K. How much could you convert before you get into the next tax bracket? $160,000. Staying in the same tax bracket. You pay tax once and move it into the Roth inside of the guaranteed new IRA. So that in distribution years, you can choose when the market's up, which bucket do we use? If the market's up, market's up. We use this bucket for income. Market's down, which bucket do you use? That bucket for income. And the way to get out of RMDs, Randy, is to move into a Roth or life insurance, both of which work great.
All right, congratulations. You made it to the end. Hopefully you learned a few things. I hope your notepad is full of notes of things that you can either go back to your existing advisor and talk about or schedule that one-on-one down below absolutely free. Remember, we don't charge for the one-on-one, and if you want to get a consultation where we can talk about where you are and where you want to end up, we don't charge for that. Hopefully, we'll be able to put you in a better position because the only reason that we exist is that we show clients how to have more income or more cash flow with less risk than they're currently taking, and there's no cost. And I hope you learned something from this. So please, whatever your takeaway is, leave it in the comments down below, share this video with your friend, and don't forget to subscribe. Hopefully, we'll talk soon. See you guys later.